Indian IT industry Q4 FY25 full report. Deal wins and total contract value Q4 FY25. Now let's dive into one of the most crucial indicators of future growth, deal wins and total contract value or TCV. In Q4 FY25, deal signings became a bellwether of client confidence and strategic realignment across the IT industry. Let's begin with TCS, which once again set the benchmark with a record TCV of $12.2 billion. What is remarkable is the diversity of this pipeline across BFSI, manufacturing, and life sciences. TCS noted strong interest in long-term transformation deals even as discretionary spending slowed. A key aspect here, more than 65% of these wins were net new, meaning brand new contracts rather than renewals. Infosys reported $2.6 billion in large deals. While lower than its recent highs, the figure still represents 63% net new wins. The company highlighted cloud modernization, cost takeout programs, and platform-led automation as key themes. However, a number of client decisions were delayed, especially in retail and regional banking in the US. HCLTech delivered a strong $3.0 billion TCV with a notable emphasis on digital engineering and infrastructure transformation. The mix of services, especially in the manufacturing and telecom sector, helped diversify the portfolio. Approximately 68% of this was net new business. Wipro came in with $1.5 billion in deal wins skewed towards renewals and extensions. The company is focusing on fewer, larger integrated deals under its new strategy and leadership changes. Their net new ratio stood at around 60%, reflecting cautious but steady progress. Among mid-sized firms, Persistent Systems posted TCV of $500 million with 75% net new wins. These were primarily in digital product engineering and cloud-native solutions. Clients are increasingly turning to Persistent for niche, high-value engagements. Coforge reported approximately $200 million in new contracts, most notably a 5-year digital transformation engagement with a global travel tech firm. 80% of these wins were net new, showing the firm's ability to penetrate new client accounts despite size. These numbers tell us a clear story. Large companies are securing big-ticket, multi-year deals, often driven by platform-led modernization. However, mid-cap firms are winning on agility and vertical depth, especially in BFSI, travel, and digital transformation services. Let's now take a quick visual look at how each company performed. Industry Vertical Analysis Q4 FY25. In this section, we take a deep dive into how various industry verticals performed for Indian IT companies during Q4 FY25. Vertical-specific demand is a major driver of deal wins, billing rates, and resource allocation. Let's start with BFSI, banking, financial services, and insurance. This sector continues to be the largest contributor to IT services revenues. However, the momentum was subdued this quarter. TCS, Infosys, and HCLTech all noted delays in core transformation projects. US regional banks and mortgage providers were particularly cautious. That said, compliance, risk management, and regulatory projects kept the lights on. Overall, the BFSI vertical saw modest growth of 1.5%. Retail and consumer goods, on the other hand, remained under pressure. Discretionary projects such as digital store transformation and omni-channel commerce were paused or deferred. Clients focused on cost takeout and warehouse optimization instead. The sector saw a contraction of around 2% this quarter. Wipro and Infosys were particularly impacted in this vertical. In contrast, manufacturing showed steady traction, with supply chains normalizing and global OEMs investing in small factory initiatives. Players like HCLTech and TCS saw new deal wins. Digital twin technologies, ERP modernization, and edge computing were key themes. Manufacturing grew 4.2% year over year in Q4. Healthcare emerged as another strong vertical. Regulatory compliance, digital health platforms, and patient engagement tools drove demand. Wipro and LTIMindtree reported good traction here. Growth stood at 3.8%. Notably, the sector remained resilient in both US and Europe. Telecom continued to be a drag on growth. Tech Mahindra, which drives a large portion of revenue from telcos, reported declines in its core communication business. 5G related transformation work was delayed in both North America and Europe. The vertical saw a contraction of approximately 3.5%. To sum it up, BFSI was stable but conservative, retail remained weak, manufacturing and healthcare were strong performers, telecom underperformed. This divergence is reshaping how companies prioritize sales, delivery, and hiring strategies across geographies and verticals. Geography-wise performance Q4 FY25. This section explores the regional performance of Indian IT companies in Q4 FY25. Different geographies showed different levels of resilience and growth, largely shaped by macroeconomic conditions, client priorities, and local regulatory environments. North America, the largest market for Indian IT firms, delivered muted growth of 1.2%. Clients remained cautious, especially in the banking and retail sectors. TCS, Infosys, and Wipro all cited delays in project ramp-ups and reduced discretionary budgets in the US. However, cost takeout and managed services deals saw some traction. Europe was comparatively stronger, showing 3.5% growth. Countries like Germany and the UK contributed meaningfully, particularly in manufacturing, energy, and financial services. Infosys and LTIMindtree reported robust pipeline conversion in this market. The region showed improved client confidence despite geopolitical uncertainties. India showed solid growth at 4.0%, increased government digitization projects, smart city rollouts, and infrastructure-led initiatives provided tailwinds. TCS and HCLTech reported strong wins in the public and manufacturing sectors domestically. APAC markets posted 2.8% growth. Australia, Singapore, and Japan were key contributors. Persistent and Coforge saw momentum in BFSI and travel sectors. Mid-cap firms are gaining ground through localized sales efforts and industry-specific offerings. Middle East and Africa delivered 1.9% growth. Though a smaller base, this region is emerging as a new hotspot for digital transformation, particularly in oil and gas, fintech, and government-led cloud initiatives. Wipro and HCLTech expanded their presence via strategic alliances. Overall, while North America continues to lead in scale, the highest growth came from domestic and APAC markets. Europe is showing promising recovery signs, while the Middle East is becoming increasingly strategic. These trends are reshaping global delivery models and sales strategies. Generative AI adoption Q4 FY25. Generative AI was one of the most frequently discussed topics in Q4 FY25 earnings calls. While monetization remained nascent, the intensity of experimentation, investment, and client curiosity reached a new high this quarter. TCS reported over 120 Gen AI pilots across various sectors. These include internal productivity use cases like code generation and knowledge search, as well as client-facing solutions in BFSI, life sciences, and retail. However, revenue contribution is still modest, around 0.4% of total revenue. Infosys mentioned more than 100 active Gen AI engagements. It has also deployed a set of internal co-pilots to assist developers, HR teams, and support staff. The revenue contribution remains below 0.3%, but the company emphasized a strong pipeline for FY26. A major focus is also on fine-tuning open-source models for enterprise-grade deployments. HCLTech stated it had 85 pilot projects underway, most of which were integrated into digital engineering and testing services. Key sectors include automotive, telecom, and healthcare. Revenue contribution stands at about 0.2%, with clients increasingly looking to co-develop IPs. Wipro, with about 75 active pilots, focused on use cases in marketing, customer support, and application modernization. The company is also rolling out internal training for over 30,000 employees in GenAI. Its revenue from GenAI is estimated to be just under 0.2%. Mid-caps are no laggards either. Persistent Systems had 40 pilots across BFSI and healthcare sectors. Revenue from GenAI reached 0.5%, which is the highest in the group, reflecting their early mover advantage and tight focus. Coforge executed over 30 pilots, especially in document intelligence, workflow automation, and smart claims processing. It generated 0.6% of its revenue from GenAI services. In summary, the GenAI race is well underway. While large firms are laying the foundation with tools, frameworks, and internal platforms, mid-tier firms are seeing faster monetization thanks to niche solutions and faster execution cycles. The industry consensus is that FY26 will be the year of production-grade GenAI deployments at scale. Hiring, training, and compensation Q4 FY25. The Indian IT industry saw a definitive shift in workforce strategies during Q4 FY25. With revenue growth stabilizing and deal wins improving, firms focused more on internal upskilling and bench productivity than aggressive hiring. Attrition rates dropped significantly across the board. TCS led with the lowest attrition at 13.3%, followed by HCLTech at 12.4%. Infosys stood at 14.6%, while Wipro, Persistent, and Coforge remained at the 13.8% to 15.2% range. This decline signals a cooling off of the talent war seen during the post-pandemic boom, along with tighter hiring pipelines. Most companies reported minimal net addition. For instance, Infosys added fewer than 5,000 employees this fiscal year compared to over 50,000 in FY22. TCS and HCLTech have reduced fresher onboarding while focusing on improving utilization of the existing workforce. One of the most prominent themes this quarter was reskilling. Over 22,000 employees at Infosys and 20,000 at TCS were trained in GenAI, with HCLTech, Wipro, and mid-tier firms also accelerating training rollouts. These programs are aimed at enabling internal talent mobility and fulfilling new-gen project demands without expanding headcount. On the compensation front, hikes remain conservative. Top performers and niche skill roles like AI, cybersecurity, and enterprise architects saw higher rewards, but company-wise increments were modest. Many firms deferred hikes for later in FY26. To summarize, Indian IT firms are maturing their workforce strategy. Instead of simply expanding headcounts, they are doubling down on productivity, reskilling, and retention. GenAI is now central to employee learning and delivery transformation, and this trend is expected to continue well into the next fiscal. Global Capability Centers (GCCs) Q4 FY25. Global Capability Centers continued to grow in significance in India during Q4 FY25. These captive units established by global enterprises for R&D, tech development, and operations are evolving from cost centers to innovative engines. As of FY25, India hosts approximately 1,780 GCCs, employing close to 1.9 million professionals. This represents a 3% growth in center count and a nearly 12% growth in employment over the last fiscal year. The expansion is driven by increased investments in AI, data analytics, cybersecurity, and cloud engineering. New GCCs are emerging not just in metros but also in tier 2 cities like Coimbatore, Ahmedabad, Indore, and Bhubaneswar. Talent availability, lower attrition, and supportive state policies are driving this decentralization. Notable recent announcements came from Fortune 500 firms in fintech, semiconductors, and consumer electronics. There is a clear trend of GCC 2.0 centers with end-to-end ownership of product design, platform modernization, and AI engineering. These GCCs are competing with service providers for high-end digital work, reshaping the outsourcing model. However, the growth of GCCs also creates opportunities for Indian IT firms. Players like Infosys, TCS, and Wipro are increasingly offering build, operate, transfer (BOT) models, transition consulting, and DevOps enablement. Mid-tier firms are providing cloud, API, and security services to support GCC operations. In effect, GCCs are both a threat and a partner. While they internalize certain services, they also expand the ecosystem for high-value tech collaboration in India. Global IT Company Comparison Q1 CY25. To better understand how Indian IT companies are positioned globally, We now examine the Q1 CY25 performance of four major international IT services players: IBM, Accenture, Oracle, and Hewlett-Packard Enterprise (HPE). Starting with IBM, the company reported revenues of $14.5 billion in Q1 2025, with a year-over-year growth of 1%. While software revenues grew 7%, its consulting segment was flat. IBM's strategic pivot to AI and hybrid cloud is underway, but large transformation deals remain slow. Its EBIT margin stood at 13.5%. Accenture maintained its industry-led momentum, reporting $17.7 billion in revenue, a robust 9% year-over-year growth. New bookings reached $18.7 billion, led by strong demand in cloud migration, ERP modernization, and AI. Its EBIT margin was 15%. Accenture continues to outpace peers in both top-line growth and digital transformation execution. Oracle reported revenue of $13.3 billion, with cloud revenue up 21% and OCI, Oracle Cloud Infrastructure, showing 45% year-over-year growth. This reflects strong enterprise cloud demand. The company delivered an impressive EBIT margin of 28%, the highest among peers. Its GenAI-based database services are gaining traction with global clients. Hewlett-Packard Enterprise (HPE) reported $7.2 billion in revenue and 2% growth. Though modest in top-line expansion, HPE is restructuring operations and has announced 5% job cuts to streamline costs. Its EBIT margin stood at 9.2%, reflecting ongoing execution challenges in its hybrid cloud and networking segments. From a comparative lens, Accenture and Oracle are leading the market in terms of both revenue growth and margin strength. IBM is focusing on strategic repositioning, while HPE is in transition mode. Interestingly, global players are seeing earlier monetization of GenAI and platform as a service offerings compared to Indian IT firms, where monetization is still in pilot or early deployment phase. In summary, Indian firms dominate in delivery scale and cost efficiency, while global players lead in AI-native platforms and early cloud adoption. As these worlds converge, the next 12 months will test who can scale digital transformation with the most impact and velocity. Strategy, M&A, and innovation Q4 FY25. Strategic transformation and innovation took center stage for IT companies in Q4 FY25, with multiple firms recalibrating delivery models, enhancing vertical focus, and executing targeted acquisitions. Let's begin with Wipro. The company signed the landmark £500 million 10-year deal with Phoenix Group in the UK to manage the Reassure business. This strategic win deepened its foothold in insurance BPO and legacy platform transformation. Wipro also continued internal restructuring to build verticalized go-to-market units under its new leadership. Coforge acquired a boutique Salesforce consultancy in Europe. This aligns with its strategy to deepen capabilities in CRM and cloud-native platforms. The deal is expected to bolster its BFSI and travel sector offerings, where real-time customer engagement is crucial. Among global firms, Accenture continued its aggressive M&A strategy with 5 acquisitions focused on AI, data modernization, and cloud migration services across Europe and North America. These micro-acquisitions allowed Accenture to scale its presence in key industries like energy, healthcare, and public sector. IBM invested in platform integration and acquired companies in the security as a service domain. These moves reflect IBM's strategy to integrate hybrid cloud with zero-trust architectures, a strong selling point for enterprise clients looking to secure distributed workloads. Private equity firms also stayed active. Francisco Partners acquired Quorum Software to deepen its offerings in energy technology and automation, while KKR acquired Ostra, a post-trade fintech platform jointly held by S&P Global and CME for $3.1 billion. This signals strong investor appetite for B2B platform plays in financial infrastructure. These M&A moves are not just about size, they are about depth. Indian firms are enhancing their vertical expertise and client-specific offerings. Global firms are betting big on AI native platforms and vertical cloud solutions, and private investors are backing scalable tech IPs in niche domains. In parallel, innovation is now being embedded into delivery models. Infosys is investing in AI led internal productivity tools, and TCS is doubling down on reusable platforms for specific industries. Persistent and Coforge are focusing on domain specific Gen AI accelerators. This round of strategic activity reflects an industry moving beyond traditional outsourcing towards integrated technology consulting, platform engineering, and AI driven value creation. Outlook and FY26 guidance post Q4 FY25. As the Indian IT industry exits FY25, companies are cautiously optimistic about the opportunities ahead. FY26 is expected to be a year of gradual recovery, fueled by GenAI monetization, large deal ramp ups, and steady digital transformation demand. Infosys issued a muted revenue growth guidance of 1% to 3% for FY26, reflecting ongoing client cautious and ramp downs in some sectors. The company has taken a conservative stance, anticipating delayed decision making in key markets like North America and the UK. HCLTech was slightly more optimistic, projecting revenue growth between 3% and 5%. It expects traction in digital engineering and IT infrastructure services, supported by strong deal wins and improved conversion rates. LTIMindtree issued a healthy guidance of 5% to 7% growth, banking on its strength in the BFSI and manufacturing verticals. The management highlighted a stable pipeline and demand for modernization programs. Among mid-tier firms, Persistent Systems has set a bullish growth target of 14% to 18%. The company is benefiting from strong digital product engineering demand and early Gen AI adoption. Its strategy of domain-led service differentiation is expected to deliver high double-digit growth. Coforge too is targeting 15% to 20% growth, driven by multi-year annuity deals in the travel and BFSI sectors. The company expects strong contributions from recent acquisitions and Salesforce-led cloud migration programs. Broadly speaking, larger firms are preparing for a soft recovery marked by margin stability and operational rigor. Mid-tier players are eyeing faster top-line expansion through niche solutions, higher offshore leverage, and focused vertical GTM strategies. Management commentaries suggest that while the first half of FY26 may remain subdued, deal flow and revenue recognition are expected to accelerate in the second half. GenAI, integrated IT/OT platforms, and cost efficiency-led transformation are likely to dominate boardrooms' agendas. In essence, FY26 will be a year of rebuilding momentum, balancing macroeconomic uncertainty with emerging tech opportunities. Firms with clear execution strategies and resilient delivery models are expected to outperform. That's all for today. If you found this helpful, don't forget to like, subscribe, and turn on the notification so you never miss an update. Thank you for watching, and I'll see you in the next one.